A K-shaped economy, together with unicorn policies, creates fat tails. This is what we are seeing in credit markets and what we are going to continue to see in 2026. We want to give you the last thoughts of the year in our last webcast of the year, thinking about some of the episodes that we have already seen in credit markets over the past few weeks and how we see that continuing in 2026. Let's talk quickly about what we see right now in the economy and markets, the policymakers' reaction function, and then the most important part, which is how to trade the tails. We know we are in a K-shaped economy. We've talked about it for a long time. We were one of the early institutions to call for a rise in inequality and populism, even years ago. This is continuing. It's not new, but it's becoming more and more extreme. The K-shaped economy is driven by a gap in productivity between the top 5% and the bottom of companies and workers. The same is true across countries, and the same is true across sectors. We see increasingly the top end doing well and the bottom end doing less well. This, again, is not new, but some of the policies that policymakers are implementing are reinforcing this mechanism. In financial markets, we see the same, a K-shaped financial market. We had this for a while. We had the Mag 7 doing better. We had top-end credits doing better than bottom-end credits. And this has been driving the market for the last few years. As a result, we have an economy where and markets where you have an increasingly small part of the population of the economy of the world driving growth, and overall valuations are pretty expensive across the board, particularly in those top-end companies, but also across credit markets as a whole. We're very close to the record bottom of spreads. In the meantime, what we have seen is that the worst part of the market has started to do a little bit less well. We've seen First Brands and Tricolor in the US, and we've seen several credits in Europe doing a little less well than before, including the chemical sector, including in the auto sector, and in the packaging sector. And particularly, as you can see from this chart, the triple C and the bottom end of the market has done less well. What's the response from policymakers? Well, the response has been more of the same, essentially trying to prolong this economic and business cycle with monetary cuts, with loose policy, and with fiscal spending, even at a time where inflation is persistent and imbalances already exist in the economy and are widening. We call this the unicorn policy response. There's a lot of cases in history where essentially policymakers were adding debt to the economy, even in an inflationary state, trying to prolong growth. Debt crises have been associated with large investments, with large military efforts in history. I mean, there's an example here from the Roman Empire where there was essentially a panic in credit markets. And credit comes from the Roman root credere, which means to trust. Essentially, the solution in this case was to recapitalize banks in a sort of TARP-like fashion. And then some level of trust came back to the banking system. However, we know how it ended. We know that the Roman Empire later on had a larger military expansion with difficulty to pay all the legions and devaluation, debasement of coins. We have had several experiences in history where governments have used money to protract their existence, to prolong a regime, to maintain power, rather than as a store of value. Right now, and this is a chart that we had for a while, we think that governments are stuck in an easing world, in a world of stimulus, for a number of reasons. One reason is the K-shaped economy. The fact that the bottom 90% are not enjoying all the gains of capitalism means that there needs to be some rebalancing. But the rebalancing is really hard. And as a result, governments spend, whether it's universal basic income or universal credit, they spend to keep the voter base happy. But the voter base and the productive base are more and more lopsided. So the amount of spending needed to keep the 90% of workers happy that are not enjoying the fruits of growth is bigger. In turn, spending and monetary easing, which go hand in hand, generate a number of collateral effects. Productivity is lower, there's misallocation of capital, potential asset bubbles, and further inequality. But there's also some external factors which are new, which we didn't have as much 15 years ago. And one of them is geopolitical risk. Geopolitical risk is rising. And the other is outsourcing of production, which also go hand in hand. China is now over 30% of global production. And indirectly, we can add that to around 40%. It goes up to 45% if we use the indirect China allies which produce goods. So there's a loss of bargaining power. And the Trump administration is exactly trying to rebalance this excess spending, this excess production that's outside of the US. But in doing so, more spending is needed in the near term. And potentially what is ultimately needed is a reset of the amount of Western debt which the Western countries owe. In other words, a reset of the monetary system. This is why spreads are so tight. Not because credit markets are extremely attractive, not because fundamentals are amazing, but because policymakers are chasing a unicorn in the attempt to reestablish their dominance, to slow down China's rise, to onshore back production to the US, and in doing so, they're easing policy to a potentially unsustainable level. We know that there's 4 ways to reduce your debt burden if you're a government, and we can group them in 3 categories. The good, which is growing, that's hard. AI will take a long time to help growth. The bad, which is reduction in spending, austerity. We don't hear that very often. Or making other countries pay, which is what the Trump administration is trying to do if you have allies which are less strong than you are. And then there's the ugly part, which is reforming monetary policy or reforming the monetary system. For example, revaluing gold reserves or creating a strategic crypto reserves and then revaluing the assets you hold in an attempt to reduce your amount of debt, or reforming banks, creating ways to monetize debt, for ways for savers or for the banking system to absorb part of the debt. The best option is hard to implement in a relatively quick time frame, but obviously there's a lot of capex and there's a lot of spending that goes in that direction. We'll talk about that in a second. Policymakers tend to go right now towards the bad and the ugly option, which means that fiscal spending and monetary easing will continue and will actually accelerate next year. So we have a situation where on the one hand, cracks are opening in the credit market, in the worst parts of the market, the bottom leg of the K. But on the other hand, there's a lot of liquidity, both fiscal and monetary, that's going into the market and the economy, and it's keeping the upper part of the K even higher. The question we're asking ourselves is how much this divergence, how can this divergence continue? How can this gap widen without fundamentals becoming unsustainable? We'll get to this in a second. And I think ultimately in history, wherever we have seen cases of large monetary stimulus, large public enterprises or military spending, and large debt overhangs being issued to achieve these goals, there has been an economic consequence, essentially a hangover aftermath. Today, we see that fiscal spending continues to grow, and it will grow next year globally, including with a higher than 7% US deficit. Central banks have curbed quantitative easing, but very quickly, as soon as long-term yields have gone up, they've become dovish again. So we expect more cuts by the Bank of England, by the Fed, into year-end and into next year, at a time where inflation is already sticky. So what is the result of all this? Investors, we are prepared for fat tails. There's going to be more downside risk and there's going to be more upside risk. This is the opposite of the Goldilocks environment. And in particular, we see downside in the credit market and we see upside in real assets as a result of the amount of liquidity that is being injected in the system to keep the economy in the West afloat. Let's map the credit market. Credit markets are on the front of the news pages today with some episodes of bad debt coming from sectors with debt overhangs, like the auto sectors or AI infrastructure, and structures which have accumulated leverage. If we think about the crisis of 2007, 2008, I was then an analyst in research, and I was pretty bearish. What we saw in 2007, 2008 was an accumulation of leverage on underlying credit instruments that had limited default risk. For example, someone sold protection on United States CDS, which yielded 1 basis point at 100 times leverage. I remember this because I was a young analyst in 2007, and it's something that looked crazy to me. Obviously, the United States didn't default, but that fund that had levered up 100 times had a margin call. Today, what we see is the exact inverse of this. Instruments that are being used in a popular way have no mark to market. So there is no volatility, but there is extremely high default risk. In other words, investors have gone from leveraging up the left side of the credit market, so the low risk, high rating instruments with low spreads, to the right side of the credit market, which includes non-rated issuers, bilateral loans with light covenants, and packaged in a private fund, in a private format without mark to market and a capital lock. The idea was that, by creating an instrument that is volatility proof or mark to market proof, you would survive a credit cycle. Well, the news is that if you lend to someone that does not give you money back, not give you capital back, your mark to market eventually goes to zero. And this is what we are seeing in private credit today. There's been a really fast growth in that segment of the market, and a lot of asset managers claimed it, marketed it as a panacea, as a new instrument, as a this time is different vehicle. But when something grows 3.5 times in a 10-year period, when a market has such a large growth, it is very likely that there is some level of capital misallocation. In the credit world, unlike in the equity world, large companies tend to be the ones which are worse. They have more debt, more leverage. And if you are a lender and you want to gain market share, very often you end up lending to companies that have worse fundamentals, that have not gotten the same credit from banks or other lenders. Equally, if you're a company that wants to borrow privately, you might do it because of better funding costs, but sometimes you might do it because you like to have less disclosure. So we've been always very skeptical about putting capital in instruments without mark to market. And we've been very vocal about our position on the private credit ecosystem. We've been short. We continue to be over the past 3 years. If we look at what the private credit universe holds, there is a lot of concentration in information technology and in AI infrastructure. We cross-checked data from the International Monetary Fund and a number of sell-side firms, including Morgan Stanley. The result is that out of the roughly $2.5 trillion in size for private credit funds, 40% has gone to information technology, which means that going forward, the economics of the AI capex and growth cycle will determine the fortunes of a lot of these funds. In the future, Morgan Stanley estimates that there is around 800 billion between today and 2028 that will be allocated to AI infrastructure from private credit funds. So that's a further near 1 trillion amount. Why is that happening? Why are private credit funds lending so much to AI? Well, one reason is that that's where the demand is. And when you want to grow a lot, you lend to where the largest demand is, which is not necessarily the best area. So there's a lot of concentration. It's almost a one-way bet if you have 50% of your fund into one asset, into one sector. And so a lot of the situation appears so that a lot of the lending in the credit market, in the private credit market, has gone into one sector and has gone into AI, intertwining the fate of AI capex, AI spending with credit markets in the private space, which begs the question of, how much growth in the AI sector is needed for private credit funds to repay back investors. How much excess capacity needs to be generated, how many inflows in private credit funds need to happen every year for the funds to be sustainable. We've seen several cases where the AI capex business model is circular, is dependent on inflows of capital from one tech company to the other. And we've also seen cases where large companies have offloaded debt by creating smaller firms that take on debt and build the infrastructure. So Nvidia, Facebook, or Microsoft, they are relying on suppliers where they have an interest in, they have stakes in, like CoreWeave or TeraWulf, and they have most of the debt, which is an easy way of offloading losses if this loss had to happen in the future. Having a large amount of funds in private debt means that to sustain, to refinance these companies, continuous inflows are needed. So even though the capital is locked, and that might give investors a sense of safety, well, we need to think about a potential need for replacement capital because these companies will need to refinance. If you have 2.5 trillion with a 5-year horizon, 5-year maturity, there needs to be a 300-400 billion of capital inflow every year. So this is not new work. We've been spending several quarters mapping, the excesses in the market, and we're positioning against some of these excesses. Always, being mindful of the cost and the timing, which can be much later in life. As we know, the market can be irrational, for longer than you can be solvent. However, we continue to see the signs of excess, even from a qualitative perspective. It's not just numbers. It's not that we are at the tightest levels in credit markets for the last 30 years. It's not only that we have the longest positioning in US investment grade over the last 15 years, but it's also that we see this time is different behavior, product innovation, alchemy, if you want, when you're hiding mark to market, and new entrants. Everyone, even asset managers with little experience in credit or let alone in private lending, have been flocking to the market just when the credit cycle is towards its end, or at least we are really late into it. Today, the first cracks are opening. There is an attempt from private credit managers to calm things down and to talk about idiosyncratic, episodic, sporadic episodes. But the reality is that the eggs are already broken, and there's been a lot of lending that's been done really quickly, and potentially some of it is below par if you had to market. In some cases, there's been loans that have been marked a lot lower than par and very quickly. So this tells you something about the lending standards in that space. How about valuations? How about the return? Well, 90% of fixed income, including government bonds, trades below 5%. So what are the returns for these risks? Well, private credit funds have returned pretty mediocre returns. I mean, they've made between 6 and 9% net over the last 3 years on average. Again, there are different sources of data, but this is pretty much as good as it gets in an environment where the liquidity premium is tiny. So the spread differential to go into any liquid asset over a liquid asset is really tiny. And that's without an adjustment for quality. Once you adjust for quality, you're probably getting paid less, which means that liquidity is mispriced in credit markets. Investors have been paying to buy illiquid assets. Central banks have been loosening policy at a time of sticky inflation. Governments have been continuing to spend, locking central banks into an easing mode with a variety of ways to pressure them, including firing governors. So we find ourselves in an environment where credit is extremely compressed. It's probably an overvalued asset class. It offers little returns, starting from a level of below 300 basis points. And fundamentals are starting to deteriorate, especially in the lower leg of the K. So the bottom end of firms, consumers, and smaller firms and sectors that cater, unfortunately, to the bottom 50% of the economy, which is not doing so well. What will central banks and governments do in the future? Well, we talked about it. They probably only have the option to keep spending as long as geopolitical risk and inequality is there. And in doing so, they are trying to keep policy loose, but something can go wrong. When you're starting from very low spreads, and when you're starting from a level of inflation which is above target, there's limited room for maneuver. So the picture that we see right now is of a relatively stable credit market, compressed by policy, with stable fundamentals, but where some signs of cracks are starting to open, where there are the signs of excess lending, there are the signs of capital misallocation. Yes, large companies have more or less kept leverage stable. There's a bit of an increase. We see a gradual rise in defaults despite easing policy, but not a rise to 10%. However, valuations are so tight that they don't compensate for the risk. And inflation above target means that there's limited room for policy easing. Should inflation go higher or defaults rise, so fundamentals deteriorate, then credit investors are exposed to large losses. The difference for someone that is long is whether you want to die quickly or die slowly, as an old man asked me. And in many, many situations, it's much better to die quickly. In other words, it's much better to have a very quick price discovery process where you are in an environment where credit gets marked lower, and then you can add risk in the names that you like, compared to a situation where you're stuck in a vehicle that is got lower quality credit and is marked slowly over time. So right now, at the tightest levels of credit spreads in over a decade, the worst thing that an investor can do is essentially locking himself or herself in a long-only strategy for 5 years, whether it has mark-to-market or not, simply because the opportunity cost will be huge. Here we show you how a very simple dynamic strategy, the green one, performs, versus a red one, which is a static strategy in credit markets. If you're able to balance the strategy and take advantage of these locations, then you outperform typically. And that is even in a very, automated way, in a very simple, rule-based way. So the question is, are we going to have volatility in the future? Well, we think we will. We already start seeing the cracks. So we're going to see some fatter tails because we see policymakers continuing to inject liquidity, and this will gradually weaken Western currencies. And at the same time, we see credit markets deteriorating, which will weaken the bottom end of the credit spectrum, and in particular areas where excess lending has happened, in particular in the private market. What are the silver linings and what are the trades? Well, if we want to really simplify it to two trades, you want to be long hard assets, you want to be long gold, and you want to be short credit. You want to be long hard assets because you know that policymakers will continue to ease, will continue to control the yield curve. There might be a new Fed chair that is less independent, and there might be different levels of yield curve control. For example, the New York Fed, which wrote a paper on gold revaluation in August, recently talked about a return to quantitative easing. This means depreciation of the dollar and depreciation of fiat currencies, and it calls for upside in real assets. Whether you are exposure through commodities, through convertible bonds, there are various ways we have implemented to do that. But it is important to not just have paper assets in a portfolio. At the same time, should the Fed remain less dovish, or should inflation surprise to the upside, or simply should the economy deteriorate a little with a slowdown in capex, for example, for the AI sector, then credit will be that asset class that leaves you with the short end of the stick because valuations are extremely tight. So you want to be short credit in the areas where investors have been lending too much and in the areas where there is extremely tight valuations and long positioning, which is essentially US high yield. Also, to some extent, US investment grade, private credit, and tech lending. We're positioned like this. So we have exposure to the upside and we have exposure to the downside. And the reason why we're able to do it is because spreads are extremely tight. So shorts don't cost a lot. And volatility is also extremely low, or it was until a few weeks ago. So we have been harvesting optionality to the upside and to the downside. We are short the whole ecosystem of private credit, lenders, borrowers, managers, and arrangers. And we have been for the past several quarters. We're long in securities, in companies that have pricing power, that can thrive with persistent inflation, that can do well, in a rising inflation environment or in a sticky inflation environment, in a rising commodity environment, particularly hard assets and assets that have scarcity. So to recap, as we go into 2026, we see some clouds on the horizon. We're coming from an environment of very loose policy, where policymakers have not reformed the economy efficiently. So the economy is even more lopsided. And to borrow a definition from a famous economist, it's K-shaped, and it continues to be more and more K-shaped. across sectors, across countries, and across firms. Strong firms are doing better, weak firms are doing worse. Policymakers not trying to fix it. They're trying to reestablish the US dominance. They're trying to realign geopolitical equilibria and supply chains. But in doing so, they're also chasing a unicorn of short-term growth, which is generated by looser fiscal and looser monetary policy. The result is that with this extremely loose policy, an excess in lending has been generated over the past few years, a rush to capture any sort of credit risk and put it into vehicles with no mark-to-market. And that has come together with one of the largest private sector CapEx plans over the last decade, which is the AI CapEx. So the need for yield has found a large borrower. However, we don't know whether the whole universe of AI firms, from energy generation to chip making to data centers, will be profitable. Some subsectors might be, other ones might be replaced by more efficient solutions. And as this happens, with record low yields, even a small loss in a portfolio can trigger, paralysis in this area of credit markets. What is the silver lining? Silver lining is that actually, if a lot of the bad lending is concentrated in private markets, this means that public markets are cleaner. There will be obviously bad names, but there's probably fewer bubbles in the public credit market, and especially in banks, which are well capitalized and have offloaded a lot of the debt or the credit risk synthetically to private funds. This leaves us in a pretty exciting situation where we are prepared for more volatility. We expect more volatility to happen in 2026, despite government easing. We continue to see the first canaries in the coal mine happening, but we have done a lot of work to map the right shorts and the right longs. So in a year that's been relatively difficult and challenging for credit funds, we're doing pretty well. We expect next year to be more challenging, and we're ready for it. So thank you so much for your time. And with that, I wish everyone a good year end and good luck for 2026. And please reach out to us if you have any questions on our strategy and our process. Thank you.